The globe is now burdened with unprecedented levels of debt, totaling $315 trillion, more than at any point in human history. Governments, corporations, and individuals owe this staggering sum, amounting to thrice the entire global economy. Annually, 10% of all goods and services produced worldwide are diverted solely to cover interest payments, not even reducing the principal sum owed. What many fail to acknowledge is that this debt is essentially unpayable. The system has been engineered so that repayment becomes impossible. Instead, interest continually flows from workers to creditors, from impoverished nations to wealthy ones, perpetually transferring wealth upward. For decades, policymakers and central banks have operated under a straightforward principle. When economic growth slows, they inject money into the system, lower interest rates, print currency, bail out failing banks, doing everything possible to forestall pain. This strategy, although somewhat successful, has only delayed the inevitable. By avoiding deep recessions, we've maintained high asset prices and minimized unemployment, yet we never reversed course during prosperous times. We refuse to let inefficient businesses fail, to clear out the deadwood that drags down the economy. As a consequence, our accumulated debt now stands at an astronomical $315 trillion, in a financial landscape plagued by excessive liquidity, overinflated markets, and countless zombie companies that should have perished long ago. Now, a different and more perilous scenario looms. A recession that may be unavoidable, driven by trade conflicts, geopolitical tensions, and interest rates that refuse to fall further because inflation remains stubbornly high. With such an immense debt load, even modest economic downturns could instigate a cascade of defaults across the system. Some economists argue that a recession is necessary, a cleansing process to eliminate inefficiencies and redirect resources toward genuinely productive sectors. But the reality is far more destructive. This isn't a carefully controlled burn to clear brush. It's an all-consuming forest fire ignited by reckless policies, with no contingency plan to contain it. To grasp the gravity of our situation, it's vital to understand what recessions are meant to do. They vary in nature, and the one approaching us will diverge sharply from past episodes. At its core, a recession is simply a period when economic output, gross domestic product, shrinks for at least 2 consecutive quarters. During such times, unemployment rises and business activities slow. Recessions stem from 2 primary types of shocks: supply shocks and demand shocks. Supply shocks are easier to comprehend. Something physically hampers production. A pandemic halts factories, wars disrupt shipping lanes, natural calamities devastate infrastructure. These cause a direct reduction in available goods, a logical outcome. Demand shocks, however, are more perplexing. Here, no physical barrier exists. Factories operate normally, workers are available, supply chains remain intact. Yet consumer spending plummets, investments stall, and households hoard cash out of fear. Businesses, sensing decreased demand, cease production and lay off workers, who then have less money to spend elsewhere, setting off a vicious cycle of economic contraction. This phenomenon played out starkly in 2008 when confidence evaporated despite all manufacturing capacity remaining. Credit markets froze, leading to recession even though the physical ability to produce persisted. Demand-driven downturns serve a tarnished but necessary purpose. They prune inefficient, overleveraged, or unviable businesses, making room for healthier ones. During periods of prosperity, these zombie companies survive by borrowing and raising investor funds, appearing successful on paper but contributing little real value. Recessions kill these entities, such as the burst of the dot-com bubble in 2001, when overhyped startups with no revenue shuttered to a halt, costing jobs and billions in investor money, but also freeing capital and talent to fuel genuine growth. Similarly, the 2008 financial crisis revealed overinvestment in real estate and complex securities. The subsequent market correction shifted capital away from non-productive assets, ostensibly making room for sustainable businesses, though intervention from governments and central banks often allowed zombie firms to survive, prolonging the malaise. Today, however, our response to downturns has changed dramatically. Central banks, Instead of allowing recessions to run their course, panic at the first sign of trouble, cutting interest rates to zero, printing trillions of dollars, and bailing out failing institutions. While these measures temporarily stabilize asset prices and reduce unemployment, the long-term consequence is an economy riddled with zombie businesses kept afloat by artificially low borrowing costs. Resources, be it capital, labor, or market share, that should be freed up instead remain locked in unproductive firms, hampering innovation and growth. The multi-trillion-dollar debt accumulated over decades is a direct result of this insidious policy. Governments, corporations, and individuals have all borrowed extensively. Governments owe roughly $100 trillion, companies another $100 trillion, and households approximately $115 trillion, all accumulated during an era of near-zero interest rates from 2008 until 2021. Now that rates have risen, the math becomes cruel. Borrowing at low rates and refinancing at much higher ones threaten to push many into default, triggers for a potentially catastrophic cascade. When defaults spread through the system, they can ripple globally, as in 2008, when Lehman Brothers' failure sent shockwaves through financial markets. Today, with over $600 trillion in derivatives intertwined with our debt, the interconnectedness amplifies the risk exponentially. The impact widens unevenly. For ordinary people, recessions mean job losses, home foreclosures, and small businesses shutting down. For the wealthy, downturns often become opportunities. Asset prices fall, enabling them to buy stocks, real estate, and businesses at bargain prices, eventually becoming richer as the economy recovers. This pattern repeats, a transfer of wealth from the bottom to the top, perpetuating social inequities. However, these downturns don't spare the healthy. Unemployment spikes, family homes are lost, and honest workers are the ones who suffer most. Meanwhile, the powerful, with resources and assets, often emerge better off. Compounding the threat, governments and central banks face limited options. In the past, cutting interest rates to fight recession was straightforward, like in 2020 when rates neared zero and massive bond purchases were made, staving off collapse. Now, interest rates are higher, and further cuts risk reigniting inflation, already running at multi-decade highs, thus constraining action. The debt conundrum deepens. Our current debt level, more than 125% of gross domestic product, is unmanageable. Borrowing even more risks spiraling into a debt crisis as markets lose confidence and borrowing costs soar. The impending refinancing surge in the next 2 years could push many entities into default, unleashing contagion across banks and financial institutions, much like the domino effect that sparked the global financial crisis of 2008. In that meltdown, the failure of Lehman Brothers revealed how interconnected and fragile our financial network truly is. Today, with vastly more derivatives and debt, the potential for a similarly devastating chain reaction is exponentially worse. Recessions are especially brutal for ordinary people. Job losses, home foreclosures, business failures. Yet the wealthy often profit from these downturns. Assets like stocks and real estate fall in value, allowing the elite to acquire those assets cheaply and then profit as the economy recovers. Meanwhile, millions of families lose their homes and livelihoods, with the social fabric fraying. The core problem remains the enormous debt, $315 trillion, that has accumulated because policymakers prioritized preventing recessions at all costs. This choice created a system that's now fragile, where even small shocks threaten to blow it apart. The risk is no longer theoretical. The systemic vulnerabilities are real and imminent. The only question now is how severe the coming crisis will be, and whether there exists any capacity to halt its progression. The debt-driven economy, built on unsustainable foundations, is teetering on the edge of collapse. The time to act might have passed, and the consequences of inaction could be devastating. When businesses find themselves unable to sell their products, they inevitably cut back production and lay off workers. With fewer employed, these workers have less income to spend, causing other businesses' sales to decline. This triggers more layoffs, and a self-perpetuating cycle takes hold. This was the reality in 2008, where no physical breakdown occurred, yet confidence plummeted. credit markets froze, and the economy contracted despite the capacity to produce more. Demand-driven recessions, though painful, serve a crucial purpose. They eliminate businesses that no longer serve a productive role, inefficient, overleveraged firms, or those producing goods nobody wants. During prosperous times, and with easy money, these companies survive by borrowing to cover losses or raising capital from investors eager for quick returns. On paper, they seem successful. In reality, they add little genuine value to the economy. These are the so-called zombie companies, rife during economic downturns that naturally wipe them out. The dot-com collapse in 2001 exemplifies this process. Late in the decade, any company with a website could swiftly raise millions, regardless of revenue or profits, driven by hype and investor enthusiasm. When the bubble burst, these ill-fated ventures collapsed almost overnight, causing widespread job losses and billions in investor losses. Yet, resources like capital, talent, and attention were then reallocated to real, sustainable enterprises like Google and Amazon, sparking a stronger economic resurgence. Similarly, the 2008 crisis stemmed from an overinflated housing bubble and risky financial derivatives. Behind these issues was a broader misallocation, too much capital funneled into flipping houses and complex securities, and an underinvestment in productive businesses. Although the crisis prompted a resource shift away from bad investments, at least in theory, government and central bank interventions kept many zombie firms afloat, preventing natural cleanup and sowing the seeds for prolonged issues. Today's landscape has changed. We no longer permit recessions to perform their necessary function. Whenever signs of economic slowdown emerge, authorities rush to intervene, cutting interest rates to zero, flooding markets with trillions, and rescuing failing institutions. While these steps can stabilize markets temporarily, the long-term damage accumulates. Zombie companies, which should have failed, borrow more cheaply, keep operating, and hoard resources. Such firms hinder genuine growth by locking up capital, labor, and market share that could support more productive enterprises. This is why the massive debt, totaling over $315 trillion globally, is so critical. Decades of preventing natural economic corrections have allowed these zombie businesses to persist, inflating the debt and fostering an economy increasingly dependent on cheap money and artificial supports. Governments borrow to stimulate economies. Corporations leverage low interest rates, and individuals borrow because rising asset prices make borrowing feel necessary to keep pace. This mounting debt delays inevitable consequences, postponing painful restructuring, propping up zombie companies, and inflating asset values. Yet, servicing this debt comes at a cost, as interest payments now consume around 10% of global output, leaving less for investment, consumption, and growth. The weight of this debt increasingly drags down economic momentum, growing ever heavier. Currently, signs point toward an upcoming recession, or perhaps we are already in one. Although data collection takes months, warning signs are evident. Trade wars breed uncertainty, business investments are put on hold, layoffs are rising, and consumer confidence continues to decline. Notably, this downturn isn't driven by overinvestment in a specific sector needing correction. Instead, it's fueled by policy chaos, failed agreements, backtracked tariffs, escalating geopolitical tensions, all setting the entire economic system ablaze, while hoping something beneficial will sprout from the ashes. Some argue the chaos might serve as a necessary correction, urging a recession to rebalance the overextended global supply chains and revive local manufacturing. If one genuinely believes the economy's over-reliance on brittle supply chains is the core issue, such a shock could prompt long-term diversification. But that's not what's unfolding. What we face is chaos without a coherent plan, disruptions that harm both exporters and importers, stemming from uncertainty that freezes decision-making, compounded by an enormous debt bubble making the entire system fragile. To grasp this, consider the debt landscape concretely. Governments owe roughly $100 trillion, corporations carry about equal amounts, and households are saddled with approximately $115 trillion. This colossal debt accumulation occurred during times of ultra-low interest rates. Between 2021, central banks kept rates near zero. Governments borrowed cheaply. Corporations issued bonds at 3 or 4%. Consumers secured mortgages at historically low rates. Such conditions were sustainable as long as rates remained low and economies kept expanding. But those conditions have vanished. Interest rates are no longer low, and economic growth has slowed. Debt issued at 3% now requires refinancing at 7 or 8%, an impossible hurdle for many. Companies that could comfortably service debt at 3% find bankruptcy inevitable at 8%. Governments, previously able to sustain low interest payments, now face potential fiscal crises, while households with affordable mortgages at 3% are at risk of defaulting once rates reach 7%. This discrepancy marks the onset of a refinancing crisis, placing enormous strain on the entire financial system. This is the moment when the refinancing barrier becomes insurmountable, and the impact is beginning to unfold. In the next 2 years, trillions of dollars in debts owed by corporations and governments will need to be refinanced, much of it at interest rates doubled or tripled from when they were originally borrowed. Some borrowers will navigate this storm, but many will not. Defaults will then cascade rapidly, setting off a chain reaction. When a company defaults on its bonds, the investors holding those securities, pension funds, insurance firms, and other stakeholders, face significant losses. If these losses become too substantial, the institutions falter under the strain, failing to meet their own obligations or requiring bailouts. This domino effect mirrors what transpired in 2008, when Lehman Brothers collapsed, forcing every lender and securities holder into losses, some failing outright, others relying on government rescues. The contagion spread swiftly across global financial markets, amplified by $60 trillion worth of derivatives. Today, the layers of interconnected debt and complex financial instruments have multiplied, with around $315 trillion in total debt and over $600 trillion in derivatives. The risk of a catastrophic chain reaction has grown exponentially. In a recession, the impact is far from uniform. It's harshest on everyday people. Workers face layoffs, small businesses shutter, and families lose their homes. Meanwhile, the economically fortunate often view downturns as opportunities. When asset values plummet, the wealthy can buy stocks, real estate, and businesses at sharply discounted prices. When the economy rebounds, they emerge significantly richer, just as in 2008, when millions faced foreclosure, only for private investors to acquire those homes cheaply and rent them back to displaced families. Wealth shifts upward, from the many to the few, and history repeats itself. The notion that recessions serve a necessary and temporary purpose, wiping out inefficiencies and clearing out deadwood, is misleading. The pain isn't spread evenly. Failing zombie companies are often the only casualties, yet healthy new enterprises struggle to emerge because credit becomes scarce. Workers lose jobs not due to their own failings, but because their employers can't access affordable financing during financial crises. Families lose homes not out of negligence, but because unemployment surges and income evaporates. Recessions do not discriminate. They indiscriminately devastate, with resources and opportunities flowing away from the many and consolidating with the already wealthy. What should instill real fear is the understanding that governments and central banks now have limited options for response. Back in 2008, interest rates stood at around 5%, allowing the Federal Reserve to slash them to zero, unleashing a wave of stimulus that helped the economy rapidly recover. During the COVID crisis of 2020, rates were near zero already, but the Fed escalated to printing $4 trillion and purchasing bonds, ultimately stabilizing markets. Today, interest rates sit at roughly 5%, leaving policymakers squeezed. If they cut rates again to stimulate growth, they risk reigniting inflation, which had previously demanded painfully aggressive hikes to control. Conversely, if they refrain from lowering rates, the economy may plunge into a harsher downturn with no clear remedy. There are simply no good options left. Government borrowing has become severely restricted. In 2008, U.S. federal debt equaled roughly 67% of the nation's GDP, allowing the government to borrow freely for stimulus measures and bailout programs. By 2020, the debt had increased but remained manageable, Yet today it stands at an alarming 125% of GDP, with annual deficits reaching into the trillions even absent a recession. Any attempt to borrow an additional $2 or $3 trillion to stimulate the economy would send bond markets into panic, triggering soaring interest rates and skyrocketing debt servicing costs. The government finds itself cornered, unable to borrow enough without risking a full-blown debt crisis. The same tools that proved effective in 2008 and 2020 no longer hold. When a heavily indebted economy enters recession, the result isn't a typical downturn but a spiraling debt deflation crisis. Overleveraged businesses and households default en masse, causing lenders, banks, to absorb heavy losses. In response, banks tighten lending to conserve capital, further constraining investment and consumer spending. This suppression of activity deepens defaults, intensifies losses, and triggers a vicious cycle. Since everyone is burdened by debt, there's little room for resilience. No savings buffer or capacity to endure the downturn. This phenomenon mirrors Japan's experience in the 1990s, when a debt bubble burst, plunging the economy into nearly 3 decades of stagnation, zero growth, and persistent deflation, losses that lasted for generations. A similar scenario could unfold worldwide now. The most insidious aspect of this predicament is that even if governments and central banks find ways to stave off the worst outcomes, the cost would be staggering. To prevent recession, they'd need to flood the system with money, an act that inevitably fuels inflation. From 2020 to 2023, governments injected trillions into the economy, causing inflation to surge to 9% in the United States, reaching levels unseen in 4 decades. Real wages lag behind rising prices, eroding purchasing power. Should central banks print another $5 or $10 trillion to halt the downturn, inflation could worsen, forcing a stark choice: endure a depression or devalue the currency. Either path results in hardships for ordinary people. Turning to trade wars, they now serve as the immediate catalyst for the economic slowdown. Tariffs are aimed at protecting domestic industries, justified by claims that other countries cheat through subsidies and dumping of cheap goods into U.S. markets, ostensibly leveling the playing field. When clearly targeted at predatory practices, tariffs can be justified. However, broad tariffs, covering hundreds of billions of dollars worth of goods from multiple nations, only sow chaos. They inflate prices for consumers, disrupt intricate supply chains, and generate uncertainty that stalls long-term investment. Retaliation from trading partners intensifies the damage. For example, when the U.S. imposes tariffs on Chinese imports, China retaliates with tariffs on American exports, devastating sectors like agriculture, where soybeans exported to China become less profitable, and manufacturing, where increased costs for imported components hit companies hard. Consumers bear the increased prices, and the overall economy suffers collateral damage. Tariffs do not safeguard American workers. Instead, they inflict harm across the board and escalate uncertainty. With tariffs fluctuating unpredictably, say, jumping from 25% to 0 within a month, businesses are paralyzed, unable to plan for the future. This hesitation causes investment to stagnate, leading to a contraction in economic activity. The notion that a recession is a necessary step to rectify overdependence on global supply chains crumbles under scrutiny. While vulnerabilities exist, some manufacturing processes have been outsourced. The abrupt destruction of these supply networks doesn't foster new domestic capacity. Instead, it triggers shortages and inflation. If strengthening American manufacturing is the goal, a strategic approach rooted in industrial policy is key. Targeted subsidies for factories, infrastructural investments, and workforce training programs. Tariffs, which only hike prices and sow chaos, are reckless. Now, let's connect this to the broader issue of debt. The staggering figure of $315 trillion in global debt was manageable as long as economic growth persisted and interest rates remained low. Both conditions, however, have evaporated. With growth waning and borrowing costs rising, debt service consumes an ever-growing slice of the economy. This leaves less capital for vital investments, research and development, infrastructure, and starves the economy of the resources necessary for expansion. As recession looms, this dynamic worsens. Shrinking economies mean tax revenues decline, yet debt obligations remain fixed. If governments borrow more to stimulate the economy, their debt service costs escalate further, compelling them to either cut spending or raise taxes, moves that only deepen the downturn. Similarly, corporations see profits evaporate amid falling revenues, but their interest payments remain unchanged. They are forced into cost-cutting measures, layoffs, asset sales, reduced investments, further weakening both individual firms and the broader economic fabric. Thus, debt not only heightens the likelihood of recession but ensures it deepens and prolongs. Crucially, the political climate is ill-equipped to navigate this crisis. In 2008, a broad consensus among governments and central banks allowed swift, aggressive intervention, bailing out institutions and preventing collapse. Today, that consensus has eroded. Trust in institutions is shattered, political polarization rampant, and populist movements demand accountability from elites for past failures. If authorities attempt another bailout, they will encounter fierce public opposition, protests, political upheaval, possibly worse unrest. The pressing question is whether governments possess the will and capacity to act. The bleakest scenario, if they choose inaction, allowing the recession to run its course, unemployment could surge to 20% or more, with millions facing foreclosure and countless businesses failing, marking a prolonged period of economic hardship. A decade of economic stagnation might, in theory, purge the weak links and lay the groundwork for a stronger future. Yet, the human toll would be devastating. An entire generation financially shattered, social cohesion fractured, and political extremism on the rise. The remedy could prove worse than the disease, especially if we fail to reach the other side intact. A recession of this magnitude risks igniting global conflict, as history shows nations driven by resource scarcity and market desperation have often resorted to war. Think of the collapse that led to World War II. Currently, conflicts flare in Ukraine and the Middle East, and a worldwide downturn could intensify these struggles or spark new hostilities altogether. Here we stand, with over $315 trillion in debt, an economy heavily reliant on cheap money, sustained by zombie companies, with central banks out of effective tools and governments unable to borrow without risking a full-blown debt crisis. Trade wars sow chaos, and the looming recession is either already underway or imminent within months. Some argue that what we need is this crisis, a brutal correction to restore balance and reallocate resources. But this isn't a precise surgical fix. It's more akin to a chainsaw ripping through the entire system, destroying not only the failing firms, but healthy businesses as well, annihilating millions of lives, and risking a global depression or conflict. The fundamental issue remains the staggering debt, an Achilles heel that renders the entire system fragile. It constrains policymakers' options and transforms any minor shock into a full-blown catastrophe. Decades of avoiding natural corrections, bailing out failing ventures, keeping interest rates artificially low, have brought us to this precipice. Now, the price is upon us, and the only questions are, how severe will this downturn be? And do we possess any means to halt its advance? And yet, as we stand at this perilous crossroads, the stark truth persists. The weight of accumulated debt, amounting to over $315 trillion, continues to threaten our economic stability.